In a bid to extend the yield curve on government debt, Ghana will offer its first 7-year bonds with 2 second-half sales. The first leg will see the sale of 100 million cedis in August, while another 100 million cedis will be sold in November. Well, according to the calendar for bond issuance released by the Bank of Ghana, one can anticipate pressure on the short end of the market as well as long-term interest rates. Well, for more on the Ghanaian bonds market, I'm joined on the line by Samuel Kofi Ampa. He's the head of research at Gold Coast Securities. Well, thank you so much for joining us, Kofi. Well, now, this is the first time the Bank of Ghana is offering debt of this duration. Now, I hear it's to extend the yield curve on government debt. Now, how is the market receiving this or preparing for it?
Well, the market is quite receiving this new message in terms of the 7-year bond, because this is basically the first time government is releasing a 7-year bond. Basically, the market is calm. I mean, if you look at the bond issues within the year, which has been highly oversubscribed, it tells you that really the people of Ghana and then the investors all over the country are really expecting such long-term in terms of the bond issues, and then waiting to know basically what the coupon rate could also be, based on the fact that the macroeconomy of this country has not been that strong.
Now, what kind of yields can we anticipate for the 7-year debt when it comes through next month?
What we are anticipating, I mean, it's quite dicey at this moment. Looking at the fact that currently the government is buying the local market around 23%, and the international market, we're looking that this bond might be between 8 to 10%, because currently, if you look at the local 91-day bill, which is going above 23%, it makes it quite dicey. And of course, if you look at the current economic situations that we have in terms of the fiscal policy problems that we are having currently, if you look at the high wage bill that the country is also facing at the moment, and basically the macroeconomic challenges, it puts the situation a little bit more not too convincing as to how much the government will be looking for in the coupon rate. But we believe it will be between 8 to 10%.
Oh, well, in the secondary market, we expect to see the sale of 600 million CD 5-year bonds in September. What's your outlook for the secondary market going forward?
Well, we are anticipating that that will also be a point where government will use that money to also offset its maturing debt. What we anticipate is that this time the secondary market might be quite active in a way, because if you look at the 750 million bond that was issued, if you look at what is happening currently at an 8.5% coupon rate, currently it is trading around in the secondary market around 4.5%. It's quite not too certain as to how the secondary market might react to this 600 million cedis worth of 5-year bond, but we anticipate that could even slow down the exchange rate and perhaps give government a boost in terms of its reserves, as in the forex reserve, and perhaps put the country in a trajectory of growth.